What is going on, everybody? Welcome to the Investing Bros live show. It is 1:50. Yes, it's different. Not 3 p.m., but because of the FOMC meeting today, we are going early. And in 10 minutes, we will find out the exact details of what the Fed plans to do when it comes to interest rate cuts. We have a poll in chat. Go vote on that poll. We'll look at that here in just a couple of minutes. But as a whole, it's kind of a dicey right to the end point. Are we going 25 basis point cuts? Are we going potentially 50? We will find out here in the next couple of minutes. But first, if you guys are ready for a fantastic show where we will look at the numbers, we'll check out the charts, tell you what to expect, but also listen to Jerome Powell's live press conference at 2:30. Make sure to go ahead and smash that like button. Let's get as many people in here as physically possible. Also, hit that subscribe button as well. And on the other side, we'll see you from.
Hey.
I was telling T-shirt during the intro. I don't think they heard us because I think we're muted during it. That introduction, I spoke like Yoda. Didn't mean to. You know, sometimes you start a sentence and you're like, oh, that's not where I wanted to go with that. Well, we're just going to say that like this. And that's how Yoda speaks, ultimately. That's the ultimate goal. T-shirt, how are you doing today?
Better than I deserve I am. 25 or 50 basis points they will cut.
Good.
Love it.
It's going to be very, very interesting. Let's go ahead and check out what's happening here. We got some movement going on a lot of different places. CME futures right now kind of hanging strong. They're not changing up too much. I'm letting this reload. All right, come on, Sea of White. Come on. Why are we deciding to take forever to load? All right, we're going to check back in on CME in the future. Poly markets has shifted. This morning, we saw as high as a 65% chance of 50 basis point release or decrease. But now we're sitting at 55% saying 25 basis points. If you take a look at the economic calendar, this is where we're going to get the information. You'll see the consensus and forecast, despite what we saw in CME and poly markets, is predicting 5.25. Now, the current rate is 5.50, so that would be 25 basis point. That is the expectation. We will have to wait here in about 7 minutes to find out what it actually means. Let's see a Fed tool. There we go. The Fed tool, actually, when I checked earlier, like 10 minutes ago, this said 63. So we're now moving a lot closer. The markets are getting pretty darn close to 50% probability of a 50 basis point cut and a 25 basis point cut. It is coming down to the wire. Ultimately, the volatility in crypto is pretty intense. You can see here on the 15-minute chart, we were trickling down this morning, lower highs and lower lows. Looking at some Bollinger Bands right there. Got a big breakout coming, it looks like. Actually, if I pull those back up, you guys see the constriction, and now we're spreading it out. So big move coming to the upside as we wait on this call. We'll have to wait and see. But for the first time since back here on September 17th, we broke in this lower high and lower low structure. So that's a good sign on the short term. But of course, everything can change here in just a couple of minutes when we do get the report. I want to throw it over to you really quickly, T-Shroom. And get your take on what you see happening today with all of the volatility. You were telling me earlier you were just kind of watching this. You were live with another group, and you just watched the poly markets flip-flopping back and forth. What's going on your front? Tell people what you think is really important as we have 5 minutes until the actual numbers.
That's right, Tim. I was over hanging out with the Kaizen community over there in Discord and having a good time, honestly. We were going back and forth here on this metric because I was a little bit surprised to see that 25 basis point is now back in the lead right here in terms of the betting odds over on Polymarket. And then I checked back later after the stream, Tim, and believe it or not, 50 basis points was back in popularity, and now we have zagged all the way back to 25 at live time, 1:54 Eastern Standard. It has just been an absolute whipsaw, and this is why here on the Investing Bros, subscribe, like the video, we have been recommending that folks do not trade this volatility. Only the most experienced traders I would expect to be dipping their toes in here, taking on some serious trades. Everyone else should be completely hands off, right, on the sidelines. Nothing wrong with that. Or we've also recommended paper trading or trading with 5 to 10% of the usual position that you'll go in and out with. So now we have already been proven right, which is just the whipsaw of the prediction markets, that this is not the time to be trading, and certainly not leverage trading. There will be times to do that. Most of the time, in fact, is a great time to leverage trade. However, right now is just too volatile, Tim. Just too much volatility.
Shlomi's in chat saying that the Federal Reserve YouTube Live says it's in 35 minutes from now. Well, 35 minutes from now is when Jerome Powell will be taking the stage to give his press conference to kind of tell us why he chose whatever number they chose and what the Fed feels about the current economic state. But the number gets released at 2 o'clock here in 4 minutes. So that's why we're here live this early. Yeah, even that. I mean, T-Shroom, I was looking at my Polymarket screen and it said 55%. And then we jumped to yours 2 minutes later and we're pushing towards 60%. It definitely looks like we were right this entire week on how we said 25 basis points is probably a lock. But then late over the weekend, they had to make things interesting. So they set all this pressure on poly markets, on CME futures to try to say, 50 basis points is coming. But we said on Monday, if you guys were with us, we predicted that was probably a manipulative move to keep people uneasy. And then in the last minute, we would start to see things shift back over to 25 basis points. So another call we got right here on the Bros channel. We get things right from time to time. We get some things wrong from time to time as well.
Now Tim, we got a comment here from Rambunk. He said, the question that everyone's asking, what cut is better for Bitcoin? Tim, is it 50? Is it 25? What's going to be better for Bitcoin? And I think there's I've got a good answer locked and loaded as well.
Some people are going to think about it in a way that says, the more we cut rates, the better it'll be for the economy to be able to borrow money. It should help a lot. It's not that simple. The best cut is going to be 25 basis points because 25 basis points communicates no fear, no panic. It communicates we like where inflation is sitting and we like where the job market is, but we want to pump the economy a little bit more. After years of not having any cuts whatsoever, after months of being paused, to go from months of zero movement whatsoever in interest rates to jump to 50 communicates fear, would tell investors there's something that the Fed knows that we don't know, that a recession possibly is coming. That would bring a lot of fear to the markets. And historically, we see the stock market at the least crash after details like that. To be fair, back in 2020, when we had a big cut in anticipation of COVID, we actually were looking at this the other day, and I've been misquoting it. We crashed after the first rate cut, right? So once the cuts got going later on in March, after COVID hit the United States like a steamroller, then we saw Bitcoin pump and the stock market jump back up. But actually, even if you look at 2020, when they cut rates based off of fear of what was coming, you saw the markets take a massive quick plunge. Well, in this case, if we do get 50 basis points, that very same thing could happen once again, where people are concerned that something bad is around the corner. They go ahead and sell their risk assets and they get away. But again, everything right now is shifting to 25. There's been no data, no news, nothing that I've been seeing that says that we need to go crazy and go 50 basis points, other than, you have, of course, JP Morgan is predicting it. Elizabeth Warren saying we need to go 75 basis points. So we got the crazies calling for extreme measures, but everything on the data side, everything from what Jerome Powell's told us in previous press conferences that he's looking at, 25 basis points to me still seems the most likely outcome. And I'm not saying the Bitcoin's going to hit a new all-time high by the end of the night, but I do believe that Jerome Powell's putting this first rate cut since all the way back in 2020 is going to spark a resurgence in the economy. This negativity and sideways boring action in crypto, borderline bearish trends in crypto, is going to reverse, and we're going to start that second leg of the bull market. You hear me right, the second leg. What do I mean by that? The bull market's already been here. Some altcoins have fallen back to levels we saw back during the bear market, but most of them are still considerably higher than bear market lows. It simply had its normal pullback before the second leg of the bull market. I do believe today, I've called it the most important day of 2024 for crypto, is going to make the difference. All right, guys, it's 2 o'clock. Let's refresh my page. Go to my screen here, T-Shroom. We're getting these numbers in here live with you guys. We're looking for 525 to be 25 basis points. If it says 500, that is going to be a 50 basis point cut. Wow. There we go. Coming in here. Well, it's not telling me the exact data point, so give us just 1 second. We are getting alerts, but they have not filled this one out.
Zero hedge just called it at 50 basis points. Zero hedge. We had a delay. Yeah.
50 basis points. All right.
It's
T-Shroom,
on.
we were wrong. We got the 50 basis points. All right. I am going to post this over on Twitter. And we're going to talk about what this means.
So this is a big deal, bros. Why is this big? You're sitting at home. Maybe you've never even tuned into a Fed rate cut before. You don't understand this. This signals to the market that the Fed is in trouble. They're having to use the shotgun when they could have been using the pistol to try to defeat the enemy that's rushing the gates right now. They've been really, really good at bringing down inflation from 9.1 down to 2.6. with just the pistol, right? But now they're having to pull out the shotgun. That 50 basis point cut is going to signal to the market that there's a little bit to fear out there. And this is not what we were predicting. Likely, a lot of level heads out there in Wall Street were also predicting 25. Tim, what are your initial thoughts here? This is big.
This is it. Go to my screen. Let's take a look at Bitcoin. Now, this is going to be confusing. Bitcoin's pumping on this news. I don't like this, and I'm going to explain why. We are pumping on this news of 50 basis points. And again, I've prefaced this morning. Is there a scenario in which Jerome Powell explains 50 basis points here in about 30 minutes and kind of calms our fears? There's a possibility, but it's not a very good one. This is a bad move. And a lot of times you guys are saying, but Tim, we're pumping. The markets are pumping. Bitcoin skyrocketed up above 61,000. Ethereum skyrocketed up here back above 2,300. Link didn't go necessarily crazy high, but 1060. We're seeing a lot of things pump. Why are you still negative right now, Tim? Because if anyone has traded FOMC meetings, you will know that the volatility is crazy. And a lot of times, the first move based on the news is actually one last good shakeout to confuse retail investors. There's a lot of people right now who are looking at this, looking at price action shoot up, and they're saying, oh, I got to go buy before it takes off without me. We're clearly bullish right now, so I got to go in here and buy and long Bitcoin. All the while, what's actually happening is the experienced traders, the institutions, they're allowing price to run up so that they can take profit and then short and cause a lot of traders in the retail world to lose out. Let's take a look here at our daily liquidations chart, and this will refresh for me. Sometimes this takes a second to load, but liquidations, I wonder if there was a specific target that we are looking at here. All right, let's just refresh this page. Come on now. Come on. Speed up with me if you can. T-Shroom, I'm going to have to come back to this while it's loading. I'm telling you right now, I know a lot of people are going to be saying this is a good sign. They're looking at the Bitcoin price going up. I don't think this is good. I think this is going to be something. I'm not saying we're going to brand new lows. I'm not saying that. I think there's a way that Jerome Powell kind of calms us down. But the number 46,000 just became a very real possibility in my book. I didn't think it was going to happen. I predicted 25 basis points. I was wrong, but I was ready, and I'm prepared with this 50 basis point cut. Unless Jerome Powell just spins a beautiful web here in about 30 minutes, I think there's a very real chance Bitcoin's dropping to 46K. Get ready, everybody. I'm not saying to sell all your Bitcoin, not saying to sell your assets. I'm saying find some dry powder because it's going to be fun here in a little bit to buy that dip if I am right about that. T-Shroom, well, I'm trying to get this page to load. Why don't you tell us your thoughts? Yeah,
let's jump around here. I've got the S&P pulled up. This baby has wicked to all-time highs here, 5,000, just short of 5,007, wicking up to 5,690 and 52 cents. Let's see. Look at the Qs. They did not get as high because they're pretty far from their all-time highs up here, up at 500, but did get a wick up to 479. Looks like. Let's jump down to Ethereum. Ethereum, not really moving too much. Did have a wick to the upside, but hasn't been able to get anywhere near its all-time highs. Of course, this is one we've been watching for a while, tracking here on the Investing Bros. Let's take a look at big tech. Let's take a look at Microsoft, how it's reacting here. We're pretty far from the market close here on the East Coast. Microsoft, of course, having an all-time high here, just short, getting close, really battling with that 500 psychological number, but up here at 468 to live price 434. On this news, it wicked up momentarily up to 435. I'm on the 4 hour, so this would have been up to date. We did get a pop here on Microsoft yesterday, up to 441. Let's see. The biggest mover in the tech space here is actually Tesla. Tesla getting a nice 2.1% move on this news, and Apple not too far behind, up 2.14. Not a lot of shedding here on the big tech side. Not a surprise after yesterday. That was a down day. You can see that illustrated here on Apple's stock price with a nice little, what is this? Probably a 2% and change gap to the downside. You get that heat map updated.
Yeah, it's up here. It's exactly what I thought. Here on the 24-hour chart, there was a level of liquidations here at 61,100. So we might not be done because I don't think we actually cleared that. But that's what we're kind of watching right now. Everyone who's watching this surge in Bitcoin, surge in the prices, what I guarantee you is happening right now is there cuts. Cuts are going to have some people believing we're going to be bullish. But to experienced investors, experienced economists, they know that's not a sign of positivity. Short-term swing trades to go high and set what we would call a bull trap. You guys have heard me talking about bear traps a lot because, again, I thought that we were going to get some bullish prints here. But as a whole, what we're looking at right now is a potential move to the upside, convincing the average retail investor it's time to go in, it's time to buy and long the market, only to buy the top and then swing price to the downside. Some of you might be wondering, I see some comments in chat. Other channels have been calling for lower levels as well. Why are we talking about a potential $46,000 Bitcoin? Well, I'll tell you right now, it has to do with a lot of levels that we have, not only on Luxalgo, but levels of support that we have in play right here as well. You guys look at this golden line. Let me turn off Lux for a second. You guys see this orange or golden line right here? This is one that Peter Brandt actually uses. I have my green line. I've been watching the support level here since back on March 4th, but he pointed out that if you were to trend March 21st, May 2nd, and then the wick here on August 5th, we have a trend to the downside. And if price were to come down here, we're looking at $46,000, $45,000. When I turn on Luxalgo, I am seeing a take profit level here on the daily chart under a sell signal that, yeah, we rallied back up after that sell signal, but only back to the smart trail. If we can break above 63,000, I'm willing to say that I'm wrong about this move to the downside, but a lot of resistance up above us, a lot of reasons to look at us down here. Same with that weekly chart. While we've been able to hold the smart trail here on the weekly chart as support, we have take profit levels below us and a massive bullish breaker block. This is a high level of buy and sell signals that I think could get revisited. We, of course, rejected on that same level back April 4th. Of 2022. We started rejecting there here in January of this year when the ETFs came out. Could we retest this level and find support? I think that's absolutely on the table. Now, I say all this to say I'm still a positive person. I'm still very long-term bullish. This is what I'm kind of getting at right here. Let's go back here, T-Shirt. I'm sorry you have my screen, but let's talk about the last time we had a big rate cut like this. If you guys want to know when it started happening, it actually started happening back here in June, July of 2019. And then in 2020, they made a massive cut in fear of COVID coming. Look at what the next couple of weeks looked like on Bitcoin. These couple of weeks were very bearish. We bottomed out very quickly and then resumed the bull market. We've drawn comparisons here more recently to what the markets looked like back in 2019 and 2020 and what the market looks like right now. Nothing's ever a perfect one-to-one ratio, but I say it all the time, history doesn't always repeat, but it often rhymes. And in this case, there's a reason to say one more good clear out down to 45, 46,000 before a resurgence does look like it's on the cards. And I just want to go back and remind people, you can go back to our split screen here, T-Shroom. Why am I bearish all of a sudden? Why am I bearish despite the fact that Bitcoin is climbing here a little bit, although it's back down towards 60,000? It's because logically, 50 basis points does not make sense if the economy is strong. 50 basis point cut does not make sense if we're headed for a soft landing and everything's okay. 50 basis points is a move you make when you've made a mistake and you see that things are getting worse a lot faster than you hoped. I'm hoping that Jerome Powell can corral it and change my mind. Again, I think the best excuse he could make is that we don't have one in October, and the Fed's looking at it and saying it looks like we're going to need to cut at least 25 basis points every single month till the end of the year. That's the best excuse I could hear at this point. But even that, it doesn't necessarily sway me. What I'm watching right now, I'll just be very honest with you guys about what would make me turn bullish once again. Let's get above this smart trail. If we get above this daily smart trail, that's that red cloud that Luxalgo gives us. We're talking about getting up probably close to $64,000. If we can accomplish that, I will turn bullish again before and move down to these lower levels. But at the moment, I had some dry powder. I was waiting to see if we got good news today to deploy it into a lot of projects I wanted to buy. I want to get more Caspa, want to buy more Chainlink. I was going to buy more Bitcoin. There's a lot of things I want to do with that money. That money is not being deployed today.
No.
That is going to sit and wait until I get further confirmation.
Now, Tim, we've got the dot plots published. We've got some GDP revisions. We're going to get to that in just a second. But I was noticing you were talking about Lux Algo, and the way you were describing it makes it seem like it makes trading easy. Trading with Lux Algo is something that we recommend here. We even have a link for a 20% discount on Lux Algo. Tim, could you tell me a little bit more about what Lux Algo is and how it makes trading easier?
I mean, ultimately, if you guys watch our show daily, you're going to all be using Lux Algo. These are the best trading buy and sell signals I've ever worked with. Again, if you're newer to trading, if you're newer to technical analysis, this is going to help you a lot. I still encourage you guys to learn more about technical analysis as a whole, but Lux Algo is kind of a little bit of a cheat code in telling you the most significant levels of resistance, of support, when to be buying, when to sell, and even then tells you levels to keep an eye on for potential take profit and stop losses. It is a beginner trader's dream. Check out the link down below. When you use our link, you get 20% off, by the way, as well.
You get 25% off. You also have 30 days to decide whether you like it or not, and you get a full refund. And Tim, you guys are just meeting us for the first time, but you also get access to our VIP trading group, where if trading is something that you're interested in learning more about, you're not just interested in the Federal Reserve and the stock market. You actually want to learn how to trade. It's a full-time job for a lot of people. You actually get access to our VIP trading group. A lot of folks we're finding getting laid off in professional industries are looking to trading to source a full-time income. Might as well give it a shot, right? If you got some savings, you can burn through for a little bit. See if you can be a profitable trader. Investing Bros is a one-stop shop to really test those skills and find out if it's right for you. Tim, we've got some interesting data here, summarized by Zero Hedge. So the Fed did not change its 2025 GDP forecast at all. It sees 2025 unemployment up just a fraction from 4.2 to 4.4, and 2025 core PCE dip from 2.3 to 2.2. And that justifies the FOMC predicting an additional 3 rate cuts from June to September. So this is data that's all coming in on their summary of economic projections, which they do not put out every decision, but this decision they did. What you're looking at here is the dot plot. I've got it pulled up on my screen. This is something you'll be probably seeing around on Twitter. This essentially is broken down into 2024, 2025, 2026, 2027, and then longer run projections. And as you can see, for 2025, there's actually FOMC members that think we will get sub 3% federal funds rate, and that is going to be that's going to be pretty intense to see. These are the midpoint target range for target level for the federal funds rate. So. We'll do a lot more interpretation of this dot plot here, but they essentially expect it to go lower and then stay around 3%. You see that median there. Let me zoom in even more. That median dot plot average does go ahead, not median, mean, does go ahead and kind of settle right around 3%. You'll notice from 2026 to 2027, it's basically the same. And then in the longer run, right? So they're going to cut now, and then in years to come, they're going to leave it at 3%. That's an interesting, and there's consensus for that. That's an interesting perspective. I don't know if that's a change from the previous SEP, the previous economic projections, but
well, and that obviously can change. What they're just saying is in the short term, we want to make it back down to 3. Let's reevaluate pretty much when we get to 3%. If you go to my screen here, T-Shroom, it did pretty much what we talked about after that initial burst on the news. we eliminated all of the gains here. Now, we're still wrestling there with $60,000, but this is what we told you guys earlier. The volatility was the only thing we could guarantee about today, and sure enough, that is happening. Someone pointed out in chat the Dixie is dropping pretty dramatically. You can see here that same time the Dixie dropped very briefly, dropped below 100, and we have not seen the Dixie below 100. Let's go back and see the last time we saw this. July of 2023. So
Wow.
a little over a year ago, we had that flash crash below. But as a whole, we have not spent a lot of time below 100 since way back in 2022. The Dixie is struggling here today. That's not surprising. Of course, with them cutting rates even dramatically like this is going to allow the biggest factors that affect the Dixie to grow. Of course, we're talking about comparing it to other currencies. If the dollar is getting high interest rate cuts like it is with 50 basis points, that's only good for the other currencies around. We're talking about the British pound, Chinese yuan, the Russian ruble, just name a currency. It's probably beneficial for them. But as well, I want to address chat here. Let's get in here, and we're going to spend the next little bit. We got 15 minutes until Jerome Powell leaves the stage. I think that we're a pretty split group at the moment. Normally, I think we have a lot more confluence of thought. I think Crux did end the poll, but what were the results of that poll? I want to say it was like 60% of people viewing right now still believe that 50 basis points is going to be bullish. Of course, that means 50% or 40% said that we're going to be moving to the downside. There's a lot of interesting opinions being given in chat. Put your opinion in chat. We're very happy to address and look through it with you. I really do. I really hope that I'm wrong and that there's a good way for Jerome Powell and us still have a move upside. But what I have learned very much so in my years of trading and my years of investing in crypto, you don't trade the points and decisions and the details that you want. You trade the ones that are put in front of you. And historically, there's no precedence. I'm not saying we couldn't change it, but there's no precedence in the history of how interest rate cuts have gone to say that the market should pump after this news. Historically, these have been the dips. I'm not predicting a 6-month crash. I'm not predicting brand new lows. I'm predicting a week or two, maybe 3, of downside pressure while we go down bottom. We kind of fix the problems, and then we regroup and start the process back to the upside. I could be wrong. Again, I'll probably say that a lot during the stream. I could be wrong. The problem is, though, again, if you're the type of person who wants to live on a whim and a prayer, all right, you can continue to hope and think, and maybe everything will turn out bullish and we'll go and hit 64,000 today. But if you stick to data and you stick to history and you stick to common trends, this has to make you believe downside pressure is coming in the short term. Nothing like this affects my bull market long term. People are going to be asking, Tim, does this change your long-term price predictions? I'm going to be putting out a lot of price predictions over the next couple of weeks about where I think the tops and the prices and the timelines for the tops of coins will be. That being said, the answer is no. I'm not. This doesn't make me say Bitcoin is not getting over $100,000 even this year. In fact, there's a good chance that one last good plunge down to 46,000 eliminates so many weak-handed holders that now it's only time for the institutions and only time for the long-term holders and the committed to buy up that dip and then take off like a rocket ship up over $100,000. All of those things I still am saying I believe are going to happen. But yesterday, or let's just be honest, about 18 minutes ago, I thought that the bottom for Bitcoin was in. And now, after this news, I'm not so certain. That's where I have to be here. See a lot of people saying that I am going to be wrong here. I think someone, NCR Legend says it depends on what Mike Powell. I don't know about Mike Powell, Jerome Powell maybe. Depends on what Powell will say. And you're right. It does depend on what he was saying. But if you think that Jerome Powell is going to come out and tell you 100% of the truth, then you're kidding yourself. It would not be responsible of him to come out and say, uh-oh, guys, recession coming, we're in trouble. We saw some data points we don't like. That's not the responsible way to do it. We will have to look for the nuances of how he answers questions. And this will be my one reserve. I'll say it again to everybody. If, and this keyword, if his reasoning was, we feel that we need to get 25 basis points per month and we don't have a meeting in October, That might be an okay answer, but I still boil down to never in the history of 50 basis point cuts when you're pivoting has that been good for the markets. Roy Collins says soft landing, no recession, maybe second half of 2025. You talking about a recession of 2025? Okay. Interesting. Yeah. Matt C says investing bros better start with 50.50 and then have to go with 50 later. Are you saying better to start with 50 than have to go 50 later? I'll say this. If we are headed for a recession, 100% you're right. Like if we are about to get bad data points, if there's job numbers that the Fed knows about that are horrific, you're absolutely right. It's better to get ahead of it. That doesn't mean price go up better. That means keep price from going crazy low better. It still communicates fear and concern, and that's the overall point that I have for here. We are back up to 60,500. So again, the volatility kind of coming back and forth. I want to make sure you guys understand, though, and I said this, no matter whether we had good news or bad news, the volatility, if you think we're going to know for certain about the markets up to the speech or even after Jerome Powell's FOMC meeting, then you're wrong there as well. Historically, these FOMC meetings, you still need another 12 to 24 hours after Jerome Powell speaks for the markets and volatility to shake out. Because you got to remember, like this, only the institutions and the whales really control which way the price is going to go. So they're going to fluctuate price. They're going to play with the emotions. There is so much volume that's going to be coming in over the next couple of hours because people think that they know how to trade this perfectly. Institutions, experienced traders, whales, they will allow you to play to your heart's content. And they will allow you to swing the price up and down and up and down. And they'll let you talk about whatever you want to talk about. But ultimately, they're the ones who are going to decide, do they want to buy and send price to the upside? Or do they want to sell, take profit, wait for a lower level, and potentially short the markets? They're the ones who are going to control which way it goes. So it doesn't, at the end of the day, it doesn't even matter how you personally feel about it. It matters how the wealth feels about it. And I'm telling you right now, the wealth looks at this kind of stuff and looks at history. I don't feel good. I don't feel good about a pump coming over this next week. It means a lot of what I have said recently. I'll be very honest with you guys. A lot of what I've said recently about a big move coming is wrong. That big move is actually going to go to the downside. I thought we had the potential to hit that 25 basis points. I thought we had the potential to make that move towards 64,000, 65,000, start setting new highs. And this is not the news we needed to have that happen.
Yeah, well, let's take a look at the bond market here. The 10-year Treasury yields down to 3.6%, wicked all the way as low as 3.6 clean. And then we also will look at the 6-month, and that is down to 4.50. So, and that's the live price, and it is pushing lower. So similar price movement to the Dixie. I'll go ahead and scroll over to the Dixie as well. Really playing with that 100 level. Could see we had a wick down below that 100 level down to 99 back here in July of 2023. Okay, so on a monthly chart, you can see that we are getting down to those levels again. It's the Dixie losing strength. But Tim, we're just a few minutes away from Jerome Powell taking stage here in the FOMC. Yeah. It's coming up just a few minutes, about 6.5 minutes. So we'll hear from him. He usually is running about a minute late for whatever reason, and so we'll just continue our commentary. But
let's read some chat here. Norwegian Noob, one of our members, said this is honestly long-term bullish. We need a slingshot back to launch over 120K next year. Norwegian Noob, 100% agree with you. And that's if you guys have been listening to what I'm saying. I know I guess I'm saying things with a lot of like bearishness and concern. I agree with what Norwegian Noob said. This will be a slingshot. But guess what? If I have a slingshot and I want the rock to go that way, I got to pull it back in the opposite direction. So what does that mean in price action? If we're going to slingshot to 120K, which I think this will do, it first has to move to the downside. So that's my overall point, but I 100% agree with you. Still long-term bullish. People should not be selling. People should not be preparing for a bear market. I think we should be preparing for a similar price movement. I'm not saying COVID. I'm not saying we're about to shut down America again. But in terms of the way the price moved, I'm preparing for a similar move to what we saw back in March of 2020. That's what I'm doing with my money at the moment. Let's keep looking here. NCR Legend says, but Tim, October's around the corner, the bullish month. Well, guess what? If we repeat what we did back in March, it was only like 3 weeks of bearishness, right?
Yep.
So maybe the last 2 weeks of September are bearish, maybe 1 or 2 weeks of October are bullish, but then, yeah, could that rebound start in October, a historically bullish month? It could, and that doesn't change anything. I guess I really should change my tone here, guys, because I guess I had so much worked up thinking we were going to be bullish here. Let's be bullish and say, guys, great buying opportunity probably coming here very, very soon. Hold that dry powder and buy some cheap Bitcoin you haven't been able to buy the price of in 6 months, if not more than that, honestly. So this is actually good news if you want to make money. But to make money, sometimes the markets have to have a crash, and then you buy when there's blood in the streets. That's what I think could be happening. Flat Smack says 50 equals a black swan ahead. I don't know if I'm going to call it a black swan, but I think the price action could respond similar to how black swans happen. A black swan event, anyone who's ever heard of this term, the whole point of a black swan event is that you don't see it coming. Well, with this news, if something bad's about to happen, we would see it coming because of those rate cuts. So I'm not predicting a black swan event because that defeats the purpose of a black swan event. You can't predict them, but I do predict something that causes the markets to have a good shakeout. And guess what we're going to be in? You're going to be around friends and family who are like, oh, still invested in that cryptocurrency? Poor you. Oh, I feel so bad for you. And then boom, a couple months later, they'll be like, hey, how do I buy Bitcoin? I know it's at 100,000 now. I should have bought back when I was making fun of you. That's how these things go. That is how these things go. Get ready for it. Just don't talk to a lot of people when we start crashing because they're gonna feel bad for you and they're gonna try to talk you out of it. Let's see. Drew P says, be bullish, Tim. Yeah, I'm being bullish. Drew. I'm bullish about buying Bitcoin at lower levels. I love it. If we're going down, then it will be a crash/correction. Yeah, I mean, call it what you want. You can call it a crash, you can call it a dip, you can call it a correction. Ultimately, Bitcoin will go on sale, and it'll get cheaper for a short period of time before we take off once again. Crypto influencers are bull rubbish. Okay. Good to know. Green Thanos. I know we got a couple minutes left here until we get there. T-Shirt, if you see a comment you want to read as well. Green Thanos says, Tim, we will see, but I really think your prediction kind of be off. But who knows? We don't know how really market's going to react. Due to previous cuts, everything looks different and not all the same. Right? But the thing is, Green Thanos, if we were just talking about cuts for the last 5 years, 10 years, 15 years, then yeah, I'd agree with you. It's not necessarily a big deal. We're talking about how the markets have responded to these cuts for 100 years. And there's just not a lot of history of this big of a move not coming with some sort of downward trajectory and price action as well. And here's the thing. Crypto is ultimately going to get away from the stock market, and people are going to understand it's the safe haven to run to get away from the weak dollar. The problem is people treat Bitcoin and cryptocurrency the way they treat risk assets, the way they treat the stock market. So for now, we're going to see them trade very similarly. If the stock market sells off, I think crypto will as well. Yeah, Wired to Serve says, but Tim, we're past the they'll laugh at you phase. We're past the phase where the institutions and the governments laugh at us. They're joining us. Your family, retail investors, people that don't, and I say retail investors, not investors, people who do not understand will always make fun of you. That's just a tale as old as time about the humankind. We feel threatened and make fun of things that we don't understand. So if I'm not in the world of crypto and I'm just watching the markets go chaotically, and I have a friend who maybe lost a couple $1,000s in the last month, the first reaction is just to make fun of them because I don't even understand what investing looks like long term. Any experienced long-term investor understands that to get the good, you got to deal with the bad as well. To get the gains, you got to deal with the crashes. That's how money is made. These are the moments that make people millionaires because they look at these opportunities and they jump on them rather than running away from them in fear. Robert Costin says, Tim, no hat till 70K, but what about a yarmulke? What is that? A yarmulke?
Yarmulke.
I don't know what that is.
Probably.
I don't know what that is. Yeah, it might be a little minute for I wear a hat. For those of you who don't know that reference, I told the community I will not wear a hat again. That our great investing pros hats. I'm not going to wear a hat again on stream until we get to 70K, and it looks like that just got delayed here a little bit with this recent news.
That's a yarmulke.
Travis Evans says, Tim, are you confident enough to sell some of your Bitcoin bag and buy in lower? Or are you holding and just using dry powder to buy more? Great question, Travis. It's not an issue of confident enough or not. It's an issue of conviction. I am not going to sell any of my long-term holdings. Now, am I going to look for potential short positions? Yes, I am. Do I have dry powder that I was potentially going to use today to buy more Bitcoin that I'm going to hold off on? Yes, I do. But now Jerome Powell is up on stage. Let's go to him and listen to what he has to say.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state. Inflation has eased substantially from a peak of 7% to an estimated 2.2% as of August. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by 0.5 percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.2% in the first half of the year, and available data point to a roughly similar pace of growth this quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment fell back in the second quarter after rising strongly in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of 2% over the next few years. In the labor market, conditions have continued to cool. Payroll job gains averaged 116,000 per month over the past 3 months, a notable step down from the pace seen earlier in the year. The unemployment rate has moved up, but remains low at 4.2%. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year, 0.4 higher than projected in June. Inflation has eased notably over the past 2 years, but remains above our longer-run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.2% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 2.7%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.3% this year and 2.1% next year, somewhat lower than projected in June. Thereafter, the median projection is 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. Our primary focus had been on bringing down inflation, and appropriately so. We are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our restrictive monetary policy has helped restore the balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remain well anchored. Our patient approach over the past year has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%. As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance, and we are attentive to the risks to both sides of our dual mandate. In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by a half percentage point to 4.75% to 5%. This recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance. We are not on any preset course. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation back down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking our questions. In July, you said you weren't necessarily thinking about a 50. You didn't want to be specific, but you said you were thinking about a 50. The inflation data last week came out a little firmer than expected. Retail was strong, third quarter GDP running 3%. So what changed and made the committee go 50? And
Good
how
question.
do you respond to the concerns that perhaps it shows the Fed is more concerned about the labor market? And I guess, should we expect more 50s in the months ahead? And based on what should we make that call? Thank you.
So, okay, a lot of questions in there. Let me jump in. Since the last meeting, we have had a lot of data come in. We've had the two employment reports, July and August. We've also had two inflation reports, including one that came in during blackout. We had the QCEW report, which suggests that suggests that the payroll report numbers that we're getting may be artificially high and will be revised down. You know that. We've also seen anecdotal data like the Beige Book. And so we took all of those and we went into blackout and we thought about what to do, and we concluded that this was the right thing for the economy, for the people that we serve, and that's how we made our decision. So that's one question. What was the second and
How
third?
do we make the, sorry, thank you, sir. How do we figure out in the months ahead, is there another 25 or 50 coming in? Based on what shall we make that call? Thank you.
Sure. So a couple things.
The data.
A good place to start is the SEP, but let me start with what I said, which was that we're going to be making decisions meeting by meeting based on the incoming data, the evolving outlook, the balance of risks. If you look at the SEP, you'll see that it's a process of recalibrating our policy stance away from where we had it a year ago when inflation was high and unemployment low, to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time. There's nothing in the SEP that suggests the committee is in a rush to get this done. This process evolves over time. Of course, that's a projection. That's a baseline projection. We know, as I mentioned in my remarks, that the actual things that we do will depend on the way the economy evolves. We can go quicker if that's appropriate. We can go slower if that's appropriate. We can pause if that's appropriate. But that's what we were contemplating. Again, I would point you to the SEP as just an assessment of where of what the committee is thinking today, what the individual members, rather, of the committee are thinking today, assuming that their particular forecasts are realized.
Go ahead, Chris.
Hi, Chris Rugaber at Associated Press. Thank you. The projections show that the Fed officials expect the Fed funds rate to still be above their estimate of long-run neutral by the end of next year. So does that suggest you see rates as restrictive for that entire period? Does that threaten the weakening of the job market that you said you'd like to avoid? Or does it suggest that maybe people see the short-run neutral as a little bit higher than Thank you.
I think the way I would really characterize it is this. I think people write down their estimate, individuals do. I think every single person on the committee, if you ask them what's your level of certainty around that, and they would say there's a wide range where that could fall. So I think we don't know. There are model-based approaches and empirically based approaches that estimate what the neutral rate will be at any given time. But realistically, we know it by its works. So that leaves us in a place where we expect, in the base case, to be continuing to remove restriction, and we'll be looking at the way the economy reacts to that, and that'll be guiding us in our thinking about the question that we're asking at every meeting, which is our policy stance the appropriate one? We know, if you go back, we know that the policy stance we adopted in July of 2023 came at a time when unemployment was 3.5% and inflation was 4.2%. Today, unemployment is up to 4.2%, and inflation's down to a few tenths above 2. So we know that it is time to recalibrate our policy to something that is more appropriate given the progress on inflation and on employment moving to a more sustainable level. So that the balance of risks are now even. And this is the beginning of that process. I mentioned the direction of which is toward a sense of neutral. And we'll move as fast or as slow as we think is appropriate in real time. But what you have is our individual accumulation of individual estimates of what that will be in the base case.
Howard?
Howard Schneider with Reuters. How close was this in terms of the decision? You do have the first dissent by a governor since 2005, I think.
Oh, wow.
Was the weight clearly in favor of a 50, or was this a very close decision?
I think we had a good discussion. If you go back, I talked about this at Jackson Hole, but I didn't address the question of the size of the cut, left it open, and I think we left it open going into blackout. And so there was a lot of discussion back and forth, good diversity of division, excellent discussion today. I think there was also broad support for the decision that the committee voted on. So I would add, though, look at the SEP. All 19 of the participants wrote down multiple cuts this year, all 19. That's a big change from June, right? 7 of them wrote down 3 or more, 17 of the 19 wrote down 3 or more cuts, and 10 of the 19 wrote down 4 or more cuts. So, there is a dissent, and there's a range of views, but there's actually a lot of common ground as well.
Follow up to that. Now that this is in the books, can you give us some guidance as sort of follow up to Steve on the pacing here? Would you expect this to be running every other meeting once we get into next year? For
Yeah,
example?
we're going to take it meeting by meeting. As I mentioned, there's no sense that the committee feels it's in a rush to do this. We made a good, strong start to this, and that's really, frankly, a sign of our confidence. Confidence that inflation is coming down toward 2% on a sustainable basis. That gives us the ability. We can, make a good, strong start, but and I'm very pleased that we did. To me, the logic of this, both from an economic standpoint and also from a risk management standpoint, was clear. But I think we're going to go carefully, meeting by meeting, and make our decisions as we go.
Gina.
Hi, Chair Powell. Gina Smilik of the New York Times. Thanks for taking our questions. You and your colleagues in your economic projections today see the unemployment rate climbing to 4.4% and staying there. Obviously, historically, when the unemployment rate climbs that much over a relatively short period of time, it doesn't typically just stop. It continues increasing. And so I wonder if you can walk us through why you see the labor market stabilizing, sort of what's the mechanism there, and what do you see as the risks?
So, again, the labor market is actually in solid condition. And our intention with our policy move today is to keep it there. You can say that about the whole economy. The U.S. economy is in good shape. It's growing at a solid pace. Inflation is coming down. The labor market is in a strong pace. We want to keep it there. That's what we're doing.
Weird answer.
Nick.
Why 50? Why not 25 though? Like that's what he's not answering.
Strong
Tim
start,
Rose of the
Tim.
Wall Street Journal.
Strong
Chair
start.
Powell, does today's action constitute a catch-up in action given recent substantial revisions to the employment data? Or is this larger than typical rate cut a function of the elevated nominal level of the policy rate such that an accelerated cadence could be expected to continue?
Okay. Multiple questions in there. But so I would say we don't think we're behind. We do not think we think this is timely. But I think you can take this as a sign of our commitment not to get behind. So it's a strong move. Sorry, your other question was?
Well, is this about what happened in the employment data between this meeting and the last meeting, or is this about the level of the funds rate, the high nominal level of the funds rate relative to what might be expected if you're trying to maintain equilibrium?
So I think it's about, we come into this with a policy position that was put in place, as you know, I mentioned in July of 2023, which was a time of high inflation and very low unemployment. We've been very patient about reducing the policy rate. We've waited. Other central banks around the world have cut, many of them several times. We've waited, and I think that patience has really paid dividends in the form of our confidence that inflation is moving sustainably down to 2%. So I think that is what enables us to take this strong move today. I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is, look at the SEP. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level. And we're moving at the pace that we think is appropriate given developments in the economy in the base case. The economy can develop in a way that would cause us to go faster or slower, but that's what the base case says.
What will happen, Tim.
In 2019, when you did the mid-cycle adjustment, you ceased the balance sheet runoff. With a larger cut today, should there be any signal inferred about how the committee would approach end state on the balance sheet policy?
So in the current situation, reserves have really been stable. They haven't come down. So reserves are still abundant and expected to remain so for some time. As you know, the shrinkage in our balance sheet has really come out of the overnight RRP. So I think what that tells you is we're not thinking about stopping runoff because of this at all. We know that these two things can happen side by side. In a sense, they're both a form of normalization. And so for a time, you can have the balance sheet shrinking, but also be cutting rates.
Colby.
Thank you. Colby Smith with the Financial Times. Just following up on Gina's question on rising unemployment, is it your view that this is just a function of a normalizing labor market amid improved supply, or is there anything to suggest that something more concerning perhaps is taking place here, given that other metrics of labor demand have softened too? And I guess in direct follow-up to Gina is, why should we not expect a further deterioration in labor market conditions if policy is still restrictive?
So I think what we're seeing is clearly labor market conditions have cooled off by any measure, as I talked about in Jackson Hole. And but they're still at a level. The level of those conditions is actually pretty close to what I would call maximum employment. So you're close to mandate, maybe at mandate on that. So what's driving it? Clearly, payroll job creation has moved down over the last few months, and this bears watching. By many other measures, the labor market has returned to or below 2019 levels, which was a very good, strong labor market, but this is more sort of 2018-17. So the labor market bears close watching, and we'll be giving it that. But ultimately, we believe, with an appropriate recalibration of our policy, that we can continue to see the economy growing, and that will support the labor market. In the meantime, if you look at the growth in economic activity data, the retail sales data that we just got, second quarter GDP, all of this indicates an economy that is still growing at a solid pace. So that should also support the labor market over time. So, but again, it bears watching, and we're watching.
And just on the point about starting to see rising layoffs, if that were to happen, wouldn't the committee already be too late in terms of avoiding a recession?
So that's our plan, of course, has been to begin to recalibrate. And as you know, we're not seeing rising claims. We're not seeing rising layoffs. We're not seeing that, and we're not hearing that from companies that that's something that's getting ready to happen. So we're not waiting for that, because there is thinking that the time to support the labor market is when it's strong, and not when you begin to see the layoffs. There's some lore on that. So that's the situation we're in. We have, in fact, begun the cutting cycle now, and we'll be watching, and that'll be one of the factors that we consider. Of course, we're going to look at the totality of the data as we make these decisions meeting by meeting.
There's some lore on that. I like that phrasing.
This is interesting stuff.
TV and radio.
It is.
To follow up on
threading
that,
the needle.
What would constitute for you and the committee a deterioration in the labor market? You're pricing in basically by the end of next year 200 basis points of cuts just to maintain a higher unemployment rate. Would you be moving to a more preemptive monetary policy style rather than, as you did with inflation, waiting until the data gave you a signal?
No, we're going to be watching all of the data, right? So if as I mentioned in my remarks, if the labor market were to
is the data in the room with us
unexpectedly,
right now?
then we have the ability to react to that by cutting faster. We're also going to be looking at our other mandate, though. We have greater confidence now that inflation is moving down to 2%, but at the same time, our plan is that we will be at 2%, over time. So. And policy, we think, is still restrictive, so that should still be happening.
I'm just curious as to how sensitive you'll be to the labor market, since you forecast we are going to see higher unemployment, and it is going to take a significant amount of monetary easing to just maintain it.
So, what I would say is we don't think we need to see further loosening in labor market conditions to get inflation down to 2%. But we have a dual mandate, and I think you can take this whole action as take a step back. What have we been trying to achieve? We're trying to achieve a situation where we restore price stability without the kind of painful increase in unemployment that has come sometimes with disinflation. That's what we're trying to do. And I think you can take today's action as a sign of our strong commitment to achieve that goal.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You're describing this view that you don't think you're behind when it comes to the job market. Can you walk us through the specific data points that you found to be most helpful in the discussions at this meeting? You've mentioned a couple, but would you be able to walk us through what that dashboard told you as far as what you know about the job market now?
Sure. So we'll start with unemployment, which is the single most important one probably. You're at 4.2%. That's, I know that's higher than we were used to seeing numbers in the mid and even below mid threes last year. But if you look back over the sweep of the years, that's a very healthy unemployment rate. And anything in the low fours is a good labor market. So that's one thing. Participation is at high levels. It's, we're right adjusted for demographics, for aging. Participation's at pretty high levels. That's a good thing. Wages are still a bit above what would be, their wage increases rather, are still just a bit above where they would be over the very longer term to be consistent with 2% inflation, but they're very much coming down to what that sustainable level is, so we feel good about that. Vacancies over, per unemployed is back to what is still a very strong level. It's not as high as it was. That number reached 2 to 1, 2 vacancies for every unemployed person. As measured, it's now below around 1, but that's still a very good number, I would say. Quits have come back down to normal levels. I mean, that could go on and on. There are many employment indicators. What do they say? They say this is still a solid labor market. The question isn't the level. The question is that there has been change particularly over the last few months, and so what we say is as the risks, the upside risks to inflation have really come down, the downside risks to employment have increased, and because we have been patient and held our fire on cutting while inflation has come down, I think we're now in a very good position to manage the risks to both of our goals.
And what do you expect to learn between now and November that will help inform the scale of the cut at the next meeting?
More data, the usual. Don't look for anything else. We'll see another labor report. We'll see another jobs report. I think we get a second jobs report on the day of the meeting, I think. Or no, on the Friday before the meeting. And inflation data. We'll get all this data. We'll be watching. It's always a question of look at the incoming data and ask what are the implications of that data for the evolving outlook and the balance of risks, and then go through our process and think what's the right thing to do. Is policy where we want it to be to foster the achievement of our goals over time? So that's what it is, and that's what we'll be doing.
Neil.
Thanks. Hi, Chair Powell. Neil Irwin with Axios. We've only been running a little above 100,000 jobs a month on payrolls the last 3 months. Do you view that level of job creation as worrying or alarming, or would you be content if we were to kind of stick at that level? And relatedly, one of the welcome trends of the last couple of years has been labor market steam coming out through job openings falling rather than job losses. Do you think that trend has further to run, or do you see risk that further labor market cooling will have to come through job losses?
I don't think a single journalist has asked him just one question.
It depends on the inflows, right? So if you're having millions of people come into the labor force, and you're creating 100,000 jobs, you're going to see unemployment go up. So it really depends on what's the trend underlying the volatility of people coming into the country. We understand there's been quite an influx across the borders.
Really?
And that has actually been one of the things that's allowed unemployment rate to rise. And the other thing is just the slower hiring rate, which is something we also
Who are you voting
watch
for,
carefully.
Chairman?
So it does depend on what's happening on the supply side. And on the beverage curve question, yes. So we all felt on the committee, not all, but I think everyone on the committee felt that job openings were so elevated that they could fall a long way before you hit the part of the curve where job openings turned into higher unemployment, job loss. And yes, I think we are. It's hard to know that you can't know these things with great precision, but certainly it appears that we're very close to that point, if not at it, so that further declines in job openings will translate more directly into unemployment. But it's been a great ride down. I mean, we've seen a lot of tightness come out of the labor market in that form without it resulting in lower employment.
Thanks, Chair Powell. Edward Lawrence, Fox Business. So we've heard some speculation that you may be going with the federal funds rate to 3.5%, maybe under 4%. And there's basically an entire generation that has experienced zero or near zero federal funds rate. Now some think we're heading in that direction again. What's the likelihood that cheap money is now the norm?
So this is a question, you mean after we get through all of this? It's just a great question that we can only speculate about. Intuitively, many people anyway would say we're probably not going back to that era where there were trillions of dollars of sovereign bonds trading at negative rates, long-term bonds trading at negative rates. And it looked like the neutral rate might even be negative. So people were issuing debt at negative rates. It seems that's so far away now. My own sense is that we're not going back to that. But honestly, we're going to find out. But it feels to me and that the neutral rate is probably significantly higher than it was back then. How high is it? I just don't think we know. Again, we only know it by its works.
And one more. How do you respond to the criticism that will likely come that a deeper rate cut now before the election has some political motivations?
Ooh.
Yeah, so this is my fourth presidential election at the Fed, and it's always the same. We're always going into this meeting in particular and asking what's the right thing to do for the people we serve, and we do that, and we make a decision as a group, and then we announce it, and that's always what it is. It's never about anything else. Nothing else is discussed, and I would also point out that the things that we do really affect economic conditions for the most part with a lag. So
little dodgy.
Nonetheless, this is what we do. Our job is to support the economy on behalf of the American people. And if we get it right, this will benefit the American people significantly.
Unburdened.
So this really concentrates the mind, and it's something we all take very, very seriously. We don't put up any other filters. I think if you start doing that,
support level.
I don't know where you stop. And so we just don't do that.
Jolene.
Thank you, Chair Powell. I'm Jolene Kent with CBS News. My first question is, very simply, what message are you trying to send American consumers, the American people, with this unusually large rate cut?
I would just say that, the U.S. economy is in a good place, and our decision today is designed to keep it there. More specifically, the economy is growing at a solid pace. Inflation is coming down closer to our 2% objective over time. And the labor market is still in solid shape. So our intention is really to maintain the strength that we currently see in the U.S. economy. And we'll do that by returning rates from their high level, which has really been the purpose of which has been to get inflation under control. We're going to move those down over time to a more normal level over time.
Just a quick follow-up to that. Listening to you talk about inflation moving meaningfully down to 2%, is the Federal Reserve effectively declaring a decisive victory over inflation and rising prices?
No, we're not. So inflation, what we say is we want inflation, the goal is to have inflation move down to 2% on a sustainable basis. And, we're close, but we're not really at 2%. And I think we're going to want to see it be, around 2% and close to 2% for some time. But we're certainly not we're not saying mission accomplished or anything like that. But I have to say, though, we're encouraged by the progress that we have made.
Katerina.
Hi, Katerina Saraiva with Bloomberg News. I just would love to know kind of how the committee is thinking about the persistence we've seen in housing inflation. Do you think you can return to 2% with housing inflation where it is?
Great question. No, you cannot.
There's some good ones.
So housing inflation is the one piece that is kind of dragging a bit, if I can say. We know that market rents are doing what we would want them to do, which is to be moving up at relatively low levels, but they're not rolling over. The leases that are rolling over are not coming down as much, and OER is coming in high. So, it's been slower than we expected. I think we now understand that it's going to take some time for those lower market rents to get into this, but the direction of travel is clear, And as long as market rents remain, relatively low inflation, over time that will show up. Just the time it's taking now, several years rather than just 1 or 2 cycles of annual lease renewals. So that's, I think we understand that now, but I don't think the outcome is in doubt. Again, as long as market rents remain under control, the outcome is not in doubt. So I would say it's the rest of the portfolio, or of the elements that go into core PCE inflation have behaved pretty well. They all have some volatility. We will get down to 2% inflation, I believe, and I believe that ultimately we'll get what we need to get out of the housing services piece too.
Some of your colleagues have expressed concern that with starting to cut rates, you could reignite demand in housing and see prices go up even more. What's the likelihood of that, and how would you react to that?
So the housing market, it's hard to game that out. The housing market is in part frozen because of lock-in with low rates. People don't want to sell their home, so because they have a very low mortgage, it'd be quite expensive to refinance. As rates come down, people will start to move more, and that's probably beginning to happen already. But remember, when that happens, you've got a seller, but you've also got a new buyer in many cases. So it's not obvious how much additional demand that would make. I mean, the real issue with housing is that we have had and are on track to continue to have not enough housing. And so it's going to be challenging. It's hard to zone lots that are in places where people want to live. It's all of the aspects of housing are more and more difficult. And where are we going to get the supply? And this is not something that the Fed can really fix. But I think as we normalize rates, you'll see the housing market normalize. And I mean, ultimately, by getting inflation broadly down and getting those rates normalized and getting the housing cycle normalized, that's the best thing we can do for householders. And then the supply question will have to be dealt with by the market and also by government.
Victoria.
Hi, Victoria Guido with Politico. Just following up on some of the labor market talk earlier, monetary policy operates with long and variable lags, and I'm wondering how much you see being able to keep the unemployment rate from raising too much comes from the fact that you're starting to act now, and that's going to give people more room to run versus just the labor market is strong. And then also, if I could, following up on Nick's question, do you see today's 50 basis point move as partially a response to the fact that you didn't cut in July, and that sort of gets you to the same place?
So you're right about lags, but I would just point to the overall economy. You have an economy that is growing at a solid pace. If you look at forecasters or talk to companies, they'll say that they think 2025 should be a good year too. So there's no sense that the U.S. economy is basically fine. If you talk to market participants, I mean, business people who are actually out there doing business. So I think
business people who are out there doing business.
Timely. I do, and as I
They're
said,
doing fine,
you can
Tom.
see our 50 basis point move as a commitment to make sure that we don't fall behind. So you're really asking about your second question. You're asking about July, and I guess if you ask, if we'd gotten the July report before the meeting, would we have cut? We might well have. We didn't make that decision, but we might well have. I think that's not, that doesn't really answer the question that we ask ourselves, which is let's look, at this meeting we're looking back to the July employment report, the August employment report, the 2 CPI reports, one of which came, of course, during blackout, and all of the other things that I mentioned. We're looking at all of those things, and we're asking ourselves, what's the policy stance we need to move to? We knew, it's clear that we clearly, literally everyone on the committee agreed that it's time to move. It's just how fast do you go, and what do you think about the path forward? So this decision we made today had broad support on the committee, and I've discussed the path ahead.
Elizabeth.
Thank you, Chair Powell. Elizabeth Schulze with ABC News. Mortgage rates have already been dropping in anticipation of this announcement. How much more should borrowers expect those rates to drop over the next year?
very hard for me to say. That's from our standpoint. I can't really speak to mortgage rates. I will say
She was so proud of that question, though.
That'll depend on how the
question
economy
for the
evolves.
people.
Our intention, though, is we think that our policy was appropriately restrictive. We think that it's time to begin the process of recalibrating it to a level that's more neutral rather than restrictive. We expect that process to take some time, as you can see in the projections that we released today. And if things work out according to that forecast, other rates in the economy will come down as well. However, the rate at which those things happen will really depend on how the economy performs. We can't look a year ahead and know what the economy is going to be doing.
What's your message to households who are frustrated that home prices have still stayed so high as rates have been high? What do you say to those households?
Well,
didn't we just talk about
what
this?
I can say to the public is that
ABC News wants their soundbite, Tim.
we had
Come
the
on.
highest. We had a burst of inflation. Many other countries around the world had a similar burst of inflation, and when that happens, part of the answer is that we raise interest rates in order to cool the economy off, in order to reduce inflationary pressures. It's not something that people experience as pleasant, but
Now let's fact check it.
at the end, what you get is low inflation restored, price stability restored. And a good definition of price stability is that people in their daily decisions, they're not thinking about inflation anymore. That's where everyone wants to be, is back to what's inflation. We just keep it low, keep it stable. We're restoring that. So what we're going through now really, it restores, it will benefit people over a long period of time. Price stability benefits everybody over a long period of time just by virtue of the fact that they don't have to deal with inflation. So that's what's been going on, and I think we've made real progress. We don't tell people how to think about the economy, of course, and of course people are experiencing high prices as opposed to high inflation, and we understand that's painful.
He's really getting to have his cake and eat it, too, with saying, yeah, we're doing 50 basis points, but the labor market's
Hi, Chair
robust
Powell.
and
Greg
great.
Robb from MarketWatch.com.
Yeah.
I was wondering if you could go through. You
good
said
frames.
We're gonna break it. We're gonna break
beginning
down
that,
a lot of this
coming
stuff
into
here
the
in a couple
blackout,
minutes.
There was like an open thought of 25 or 50. The Fed could move either 25 or 50. I would sort of argue that when we had those two last speeches by Governor Waller and New York Fed President John Williams, that they were sort of saying that maybe a gradual approach was going to win the day. I mean, I sort of want to ask a 7-part question about this, but I mean, could you talk? Would you have cut rates
Journalist
by
humor.
50 basis points if the market had been pricing in like low odds of a 50-point move like they were last Wednesday? After the CPI number came out, it was a really small probability of a 50-point cut. Does that play in your consideration at all? Just talk a little bit about that. Thank you.
We're always going to try to do what we think is the right thing for the economy at that time. That's what we'll do. And that's what we did today.
Simon.
Short and sweet.
But that means that you think the economy's in trouble.
Thank you, Chair Powell. Simon Rabinovich with The Economist. You've mentioned how closely you're watching the labor market, but you also noted that payroll numbers have been a little bit less reliable lately because of the big downward revisions. Does that put your focus overwhelmingly on the unemployment rate? And given the SEP projection of 4.4 basically being the peak in the cycle, would going above that be the kind of thing that would trigger another 50 basis point cut?
So we will continue to look at that broad array of labor market data, including the payroll numbers. We're not discarding those. I mean, we'll certainly look at those, but we will mentally tend to adjust them based on the QCEW adjustment, which you referred to. There isn't a bright line. It will be, the unemployment rate's very important, of course, but there isn't a single statistic or a single bright line over which that might move that would dictate one thing or another. We'll look at each meeting, we'll look at all the data on inflation, economic activity, and the labor market, and we'll make decisions about is our policy stance where it needs to be to foster over the medium term our mandate goals. Yeah, so I can't say we have a bright line in mind.
Matt Egan.
Thanks, Chair Powell. Matt Egan from CNN. I know that you discussed earlier how the Fed does whatever the right thing is and nothing else factors in. But in general, can you talk about whether or not you believe a sitting U.S. president should have a say in Fed decisions on interest rates? Because that's something that former President Trump, who obviously appointed you, has previously suggested. And I know the Fed is designed to be independent, but why? Can you tell the public why you view that so important?
Sure. So countries that are democracies around the world, countries that are sort of like the United States, all have what are called independent central banks. And the reason is that people have found over time that insulating the central bank from direct control by political authorities avoids making monetary policy in a way that favors maybe people who are in office as opposed to people who are not in office. So that's the idea, is that, and I think the data are clear that countries that have independent central banks, they get lower inflation. And so we do our work to serve all Americans. We're not serving any politician, any political figure, any cause, any issue, nothing. It's just maximum employment and price stability on behalf of all Americans. And that's how the other central banks are set up too. It's a good institutional arrangement, which has been good for the public. And I hope and strongly believe that it will, continue.
Kyle.
Kyle Campbell for American Banker. Thanks for taking the questions, Chair Powell. A couple regulatory developments in the past week that I want to ask you about. First, last week, Vice Chair for Supervision, Michael Barr, outlined his views for the changes to the Basel III Endgame. I'm wondering if you are in alignment with him on what those changes should be, if those have support on the board in a broad way that you're looking for, and if you think the other agencies are also fully on board with that approach. And then yesterday, other banking regulators.
You know what? Hold the second question.
Okay, sure.
Let me we'll give you the second question. So the answer to your question is that yes, those changes were negotiated between the agencies with my support and with my involvement, with the idea that we were going to repropose the changes that Vice Chair Barr talked about, and then take comment on them. So yes, that is, that's happening with my support.
Okay. Is there a date for that?
That's not a final proposal, though. You understand? We're putting them out for comment. We're going to take comment and make appropriate changes. We don't have a calendar date for that. And as for the other agencies, the idea is that we're all moving together. We're not moving separately. So that I don't know exactly where that is, but the idea is that we will move as a group to put this again out for comment, and then the comments will come back 60 days later, and we'll dive into them, and we'll try to bring this to a conclusion sometime in the first half of next year.
Right. And then yesterday there were merger reform finalizations from the other bank regulators. Well, what does the Fed have to do to align itself on merger?
I would bounce that question to Vice Chair Barr. It's a good question, but I don't have that today. Thanks.
Okay, we'll go to Jennifer for the last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said earlier that the decision today reflects with appropriate recalibration strength in the labor market that can be maintained in the context of moderate growth. Even though the policy statement says you view the risks to inflation and job growth as roughly balanced. Given what you've said, though, today, I'm curious, are you more worried about the job market and growth than inflation? Are they not roughly balanced?
No, I think, and we think they are now roughly balanced. So if you go back for a long time, the risks were on inflation. We had a historically tight labor market, historically tight. There was a severe labor shortage. So very hot labor market, and we had inflation way above target. So
when you shut down an entire economy,
concentrate on inflation, concentrate on inflation, and we did for a while, and we kept at that. The stance that we put in place 14 months ago was a stance that was focused on bringing down inflation. Part of bringing down inflation, though, is cooling off the economy and a little bit cooling off the labor market. You now have a cooler labor market in part because of our activities. So what that tells you is it's time to change our stance. So we did that. The sense of the change in the stance is that we're recalibrating our policy over time to a stance that will be more neutral. And today was, I think we made a good, strong start on that. I think it was the right decision, and I think it should send a signal that that we're committed to coming up with a good outcome here.
It's a strong start, Tim.
Vulnerable to a shock now that could tip it into recession.
I don't think so. I don't, as I look, well, let me look at it this way. I don't see anything in the economy right now that suggests that the likelihood of a downturn is elevated. Okay, I don't see that. You see growth at a solid rate. You see inflation coming down, and you see a labor market that's still at very solid levels. So I don't really see that. No. Thank you.
Thank you.
All right. that went longer than I thought. 3:20. All right. Initial thoughts, T-Shroom. I'm going to let you start off. Give me your, don't go into detail on anything. Just give me your initial thoughts about points that he tried to make. Did he do a good job of convincing us that 50 basis points can still go along with a soft landing? And obviously that's what he wanted to communicate, but do you buy it? What are your thoughts?
I halfway buy it. And I think I'm trying to figure out who is the audience here, right? And it's Wall Street. It's Wall Street, and it's to some extent everyday, wealth managers out across the United States that are making decisions on behalf of their client. I think they're very much convinced. I think Wall Street is convinced, and I think that they're convinced. Convinced of what? Convinced that Jerome Powell is going to have his cake and eat it too. They're going to have this strong start, 50 basis points, but then they're also going to say that the labor market is robust, right, and strong, and it's in the place they want it to be. Those things really shouldn't coexist, but Jerome Powell, I think, just worked his magic, and he just made them fit. He just made those two things fit that really shouldn't fit. You shouldn't have a good labor market and good inflation numbers, and then a bazooka cut. That's my take.
Yeah, I'm open to the concept. He said over and over again he likes where the economy is sitting, but he continues to say we'll just monitor the data as it comes. Right? He didn't really get into the details. He said we think that 50 basis points is the right move for the economy. He never explained, and I guess no question really pushed him hard enough to explain it.
Yep.
But why wasn't 25 good enough? No one asked that specific question. And I don't feel like what he answered gives us a good reason. So he wants us to believe that the jobs are okay, that inflation's okay, that the economic growth is okay, but we need to drop by 50 basis points. I mean, never in the history of how we've handled interest rates has a 50 basis point cut not been a bad thing. And it's one of those things that said, like, it's like, okay, I think at one point he mentioned, he's like, hey, we'll be able to speed up or slow down at any point we want. Okay, why come out with a bang? If the economy is doing so well, and even the last question that was asked pretty much said, are you concerned about are there anything in the numbers that are saying that it could be bad? And he pretty much said, no, not right now. Nothing's bad. Okay, so why 50 basis points, right? I clarified that in the beginning. A part of me wanted to hear him say, oh, it's because we think that we need 25 in both this month and October. There's not going to be a meeting in October. So we decided to kind of put out, instead of having to have like an emergency October cut, we just went ahead and did 50 now. But that's not how he explained it. He ultimately tried to, I think you said it in the video, he's like, he tried to have his cake and eat it too. Everything's okay, but we're going to get severe with rate cuts. I think there were elements of what he answered that made it sound like there might be some outside voices talking to Fed members. One of the questions that I don't think he handled very well and didn't give us a lot of clarity is one of the questions was, in July, you were very much saying 50 basis points is not on the table. We'll consider 25, but we'll see what changed between now and then. And aside from saying, the data points, he never really gave us a lot of thoughts there. So it's one of those things that I hypothesized earlier today. I was like, well, what if 50 basis points come and everyone was expecting it, so it ends up just trading sideways? That's possible. I'll tell you this right now. After listening to that speech, I'm not bullish. I know a lot of people are going to want to be bullish. I'm not bullish. I know he put in a lot of confidence. I know he says there's no recession coming. But let's be fair. I've actually liked how Jerome Powell's handled things over the last year and a half. I did not like how he started rate hikes, right? So if you go back to February of 2022, it was so very obvious we needed to start raising rates. And he said, well, when I look at the data, it's not that bad, actually. So we're going to hold off for now. And then effectively over the next 6-7 months, we pretty much heard him say, yeah, that was a mistake. Yeah, shouldn't have waited that long. Yeah, we're in trouble. We're going to have to raise rates a lot higher for a lot longer. I have a feeling it's going to be something similar here, where it's like, I mean, and maybe he's doing the responsible thing, but I'm just saying, I don't see a logical reason, and he didn't give a logical reason for 50 over 25. He simply said the economy is good, jobs are historically good, we just don't want them to get worse. He addressed the fact that fake numbers have been, that's nothing he said from the podium. He talked about the fake numbers when it comes to payroll that had been coming out. There's just still a part of me that thinks that this is potentially a move of saying, at best, we're afraid things could get out of control, so we got to be aggressive up front. What does that mean for price action? A lot of people in chat bullish. A lot of people in chat are bullish. And guess what? I'm going to continue to stick to what I said earlier. If we get to 64,000, I am willing to say, all right, I think we're in a good spot. The problem is, you gotta stick with history until it changes. Until history turns out to be wrong, your best bet in investing is to stick with investing history. And the history is 50 basis points comes out of fear. It also depends on how will whales, how will institutions, how will large holders listen to what he just said, and how will they respond? Will they feel bullish? I mean, I think he did a great job of making the average retail investor feel good about themselves. But if we're being honest, did he say enough to make the big money feel safe? That's where I'm questioning and saying I'm not so certain he did. Am I guaranteeing 46,000? I said earlier, if 50 basis points hits, I think 46K is on the table. I'm not going to say I'm guaranteeing that either. I do think we're probably going to drop back into the 50s. I do think, I told you guys beforehand, if you guys are going to watch the screen, we were watching the charts. We put that up there because a lot of people want to see it. The short-term volatility really does not matter. We will not know what way the market actually wants to treat this for probably at least another 12 to 24 hours. It'll be tomorrow. Tomorrow's live show at 3 p.m. We'll probably have a good understanding of how the market actually wants to respond to this. Are there sides to say that this could be bullish? Yes. I'm not going to say there's not. But anyone who thinks this was a slam dunk or a home run or, Jerome Powell put me at ease, 50 basis points is what we needed. There's a lot of fluff that he left out. A lot of details that I'm not necessarily certain about. I told you before the press conference, I said, do not be surprised for him to come out and say the economy is doing good and everything's okay. But every time he got pushed about the future, he kind of stopped and said, we'll worry about when the time comes. We'll worry about that month to month as the data comes out. But for right now, we think we're okay. That's the same type of thinking that got us in trouble back in early 2022 because the data wasn't severe yet. Even though we saw the train coming, he waited too long. In this case, it's like, is he going to be dishonest with us and say that everything's fine all the while he's preparing for something bad to happen? That's the type of move you make with 50 basis points.
Yeah.
That's kind of, I really want to, Timur says I'm overthinking. I might be overthinking a little bit, but some people are underthinking. I wish that I could tell you, hey guys, this is a very clear buy or sell. Just like common fashion, this is a brain teaser that you have to sort through the BS. You have to sort through the chaos. You have to sort through the good and the bad, and then ultimately come out to what is the highest probability. And unfortunately, I know a lot of you are going to say, Tim, he was so positive. The economy's doing well. Is that the highest probability, or is the highest probability the repeating of history that 50 basis points is oftentimes coming in anticipation of something worse? Again, I also said he's not going to admit to it, but it definitely sounds like potentially outside voices are coming in to help the Fed make decisions. They pivoted their thoughts within the last 2 months. 2 months ago, we're not even certain if we're going to have cuts in 2024. Now, all of a sudden, we're not even having cuts. We're going severe with 50 basis points. Something happened over the weekend that made a lot of people start predicting 50 basis points. What is happening that certain people understand, others do not? I think it's going to be an interesting next couple of days for sure, next couple of weeks. But as a whole, history says you should not be bullish right now. You should be looking for some form of a pullback. We'll monitor that tomorrow. Again, yep. I'm going to go ahead and pause from here, T-Shroom. If you have anything else you want to say, you can comment. I'm going to go ahead and say, listen, right now I'm leaning bearish, but I'm open to long-term bullishness. We will have a much more informed opinion on this tomorrow in the afternoon 3 o'clock show, because the volatility and the chaos will be kind of at bay, and it'll go away, and then we'll actually determine and see where's the smart money moving. Eye of the Beholder says, he reminded me of the quote I say all the time, history doesn't repeat, it rhymes. Yes, that's kind of what I'm saying here. I'm not saying we're going to see an exact repeat, but it rhymes, meaning these types of movements often come with crashes in markets. Yeah. That's what you need to walk away with. T-Shirt, any closing thoughts from you before we wrap up the show?
Yeah, I mean, Jerome gave basically two answers to the big question of the day, right? Which is why 50, not 25, right? And the first answer is we want to have a strong start. That's the talking point, right? That's going to be what, economists that are behind Jerome and behind Keynesian economics are going to be able to say at these like, kind of backroom parties and things like that. It's a strong start, right? And that ends the conversation. And then the other answer is, a long, deliberate going through all the data. This is why we would do this. This is why we do this. This is why we do this. But pay attention. There was one thing that happened in this event that hasn't happened since 2005, and that's that there was a descent, right? That's something I'm going to be doing a lot more research into, trying to find exactly what that means. But something, you're absolutely right, Tim. Something changed, because if you take a look at this, out of 114 economists, 105 of them were wrong, expecting 25 basis points, right? So something did happen here, something that the market was not really anticipating. A strong start is one way to say it. I think, unfortunately, there could be the potential that getting Kamala across the finish line with a robust, strong stock market could be the other way to answer this question. It's a partisan take, right? Or it's maybe not a partisan take, but it's a political, cynical take. I think at the end of the day, bond yield, I saw in the comments here, bond yields are going to go down. Bond yields are going to be less attractive. What does that mean? It means money's going to flow into risk assets with higher returns. Okay. So that's ultimately good for Bitcoin. It's good for NVIDIA. It's good for Microsoft, right? These are the things that as investors, I want to see. Does it bode well for the long-term U.S. economy? No, it does not. This is not on track for success with $35 trillion of debt. Yeah. But that's why I like Bitcoin a lot more, because it's outside of the system that is crumbling. It's still got a nice coat of face paint on to be able to deceive investors, deceive homeowners, deceive citizens. But at the end of the day, Bitcoin is that way to get outside of the system while also getting upside exposure. So Bitcoin, check it out.
The long-term trajectory of Bitcoin and crypto is still extremely bullish. Want to make sure you guys understand that. Even when we talk about the recessions, we're not even necessarily saying a recession is going to happen. Maybe that part of what Jerome Powell is saying is true, but if there's concern of a recession, that's enough to make a big pullback. What we're talking about here, everybody, go to my screen here real quickly. If let's just pretend that 46K happens, right? We're talking about a pullback of roughly 20%. Just because of concern. Well, we've seen that several times within the last couple of months. There was no technical recessions in any of these pullbacks. Pullbacks don't happen because something terrible happens in the economy. They happen when people think something bad is going to happen in the economy. So with Jerome Powell trying his very hardest to not say that's going to happen, we're going to find out over the next 24 hours. Do the American people believe him? Does smart money believe him? Will we see a lot of sell-offs, or Will people be buying up the dip? Are people excited about 50 basis points? Come back tomorrow to find out exactly how that will end up playing out. Make sure to smash your like button, or smash the like button on the way out. Hit subscribe to the channel. Thank you so much for tuning in with the Investing Bros. We're going live here in just a couple of minutes with our YouTube members over in Discord. So whatever membership option you have, come join us. We can talk more about this. We can talk about other things. Love seeing you guys here. See you tomorrow. Adios.
Trying to make paper, turn that better to cake. Money like Lego, connect the dots, stack bank. We are investing bros. We are investing bros. Army pipe, lethal on trade. Entries and exits, worthy of praise. Tim, the professor of the TA. Shout it out loud on the PA. T-Shrooms news, got the word. Doing better than what he deserves. Beamer, leave no evidence. Soon fly coop with his dividend. Trying to make paper, turn that better to cake. Money like Lego, connect the dots, stack bank. We are investing bros. We are investing bros. Investing bros. Investing bros. Investing bros. Investing bros. Investing bros.